Are dividends really free money in retirement? In the next 12 minutes, I'm showing you exactly why chasing high dividend stocks is the wrong approach for your retirement portfolio. Here's what most investors miss. Dividends aren't bonus payments. They're your own money being returned to you. And high yield dividend stocks, they're often bleeding companies in disguise. This matters right now because you're building your retirement strategy on a foundation that could crumble. Here's what I see the most. I meet retirees who built their entire strategy around dividend income. They thought they were safe, conservative, smart. Then the dividend gets cut, and that retirement income drops 30% overnight. The investors who didn't focus much on dividends, they're actually wealthier in retirement. Your total return matters more than your dividend yield. Always. In this episode, you're going to learn 3 wealth decision principles to remember to become smarter with money and an action plan to help you make better wealth decisions starting today. But before we get into this episode, this is Brian. I've been a financial advisor for over 25 years. I'm also an author and certified life and health coach. And my goal is to help you save smarter, invest better, and keep more. So what exactly is a dividend? It's a distribution of company profits to shareholders. It sounds like free money, but here's what they don't tell you in those dividend investing books. When a company pays a dividend, the stock price drops by the exact amount. If you own a stock worth $100 and it pays a $3 dividend, you now have $97 in stock value plus $3 in cash. You haven't made money. You've just moved it from one pocket to the other. Quick question for you. Have you ever bought a stock specifically because of its high dividend yield? Let me know in the comments. So think of dividends like this. You own a house worth 500,000. You decide to sell the garage for 50,000. You now have 50,000 in cash and have a house worth 450,000. Did you get richer? No. You just changed the form of your wealth. That's exactly what dividends do. So here's the dividend illusion. Let me show you something that changed how I view dividends forever. Last month, a couple came into my office, both retired teachers. They had about 800,000 invested entirely in high dividend stocks. The average yield about 6%. They were proud. They said to me, we're making $48,000 a year without touching our principal. I pulled up their account statement. I noticed their account value had dropped to $650,000. They received about $240,000 in dividends over those 5 years, which sounds really great. But their portfolio had lost $150,000 in value. The net gain, $90,000 over 5 years. That's less than a 2% return over that period of time. Meanwhile, the S&P 500 nearly doubled. So this leads me to wealth decision principle number 1. Don't confuse cash flow with wealth creation. Just because money hits your account doesn't mean you're getting ahead. What matters is your total net worth growth. A company that pays you 5% in dividends while the stock drops 10% doesn't help you. It actually hurts you. Remember this every time you see a high dividend yield stock screaming for your attention. Before we move on, I just wanted to thank you for listening to the Wealth Decisions podcast. I'm new to YouTube. I've been doing an audio only podcast for over a year and a half and done about 100 episodes. And my goal is to reach over 250,000 people in the Twin Cities and beyond. So I would love if you came along on that journey. So subscribe to the podcast, leave a comment, share it with a friend. And by the end of this video, you're going to have a step-by-step action plan that will help you build a retirement strategy focused on what actually matters: total return, not just income. So let's talk about why high dividend stocks are red flags. Let me ask you something. If you owned a thriving business growing 20% every year, would you take cash out or would you reinvest profits to grow even faster? Smart business owners reinvest. They know compounding growth beats immediate cash. High dividend companies do the opposite. They're handing you cash instead of growing. Why? Usually because they can't find growth opportunities in their own company. They're mature, stagnant. Sometimes they're dying. For instance, let's look at General Electric. For decades, it was a dividend darling, reliable, safe. But in 2009, they cut their dividend by 68%. The stock crashed from 30 to 6, and retirees who depended on that income were devastated. Or let's look at AT&T. They paid a huge dividend for years, then cut it in 2022. The stock's down 40% from its peak. Income investors lost twice. Dividend income down and portfolio value crushed. And this leads me to wealth decision principle number 2. Every dollar a company pays you in dividends is a dollar they can't reinvest in growth. And growth is what compounds your wealth exponentially. Young investors, especially, you should want companies to keep every penny and grow it at 15 to 20% annually. Take your dividends later when they're massive because the company grew 10x. That's patient wealth building. Now let's talk about the total return strategy. That's capital appreciation plus dividends, not just dividends alone. Let me show you two portfolios, both starting with 500,000. Portfolio A, high dividend stocks, 6% yield, 2% annual appreciation. Total return, 8%. Portfolio B, growth-focused stocks, 1% yield, 9% annual price appreciation. Total return, 10%. After 20 years, Portfolio A is worth 2.3 million. Portfolio B is worth 3.4 million. That's 1.1 million more by focusing on total return instead of just dividends. But what I get a lot in my practice as a financial advisor is people say, well, but Brian, I need income in retirement. And I get it. And here's what you do. You build your portfolio for total return, then create your own dividends by selling shares when you need income. It's called systematic withdrawals. So let's say you have 1 million, you need 40,000 this year. Don't search for 4% dividend stocks. Instead, invest in a diversified portfolio targeting 8 to 10% total returns. Then sell 40,000 worth of shares each year. Why is this better? 3 reasons. Number 1, you control the timing. You decide when to sell based upon market conditions and tax efficiency. Number 2, if this money is in a taxable investment account, you avoid paying dividend taxes every single year. You only pay capital gains when you sell. Number 3, you're not locked into underperforming companies just because they pay dividends. So quick question for you. Does this shift how you're thinking about retirement income? Reply to my pinned comment and share your biggest takeaway so far. So now let's talk about the tax advantage. Here's something most dividend investors miss. Qualified dividends are taxed up to 20% federally. If you've held investments for over a year, you'll most likely pay only 15% or possibly 0% in retirement, depending upon your tax bracket. You control when it happens. You harvest losses to offset gains. You can sell in low income years. Dividends, they hit you whether you need the money or not. In just a moment, I'm going to give you the exact action plan to shift from dividend dependency to total return mastery. This is the implementation you've been waiting for. But before we do that, let's talk about wealth decision principle number 3. Build wealth first, create income second. Your accumulation years are for growth. Your distribution years are for income. Don't confuse the two. If you're under 60, dividend income is often a distraction from building maximum wealth. Focus on total return. Let your portfolio compound. When you're 65 with 3 million instead of 1.5 million because you prioritize growth, you're going to thank yourself. The income takes care of itself when the portfolio is big enough and diversified. So here's your action plan. Do this today. Step 1, pull up your portfolio right now. Calculate your total return over the last 5 years. Not just dividends, stock appreciation plus dividends. Compare it to the S&P 500. Are you winning or losing? Step 2, identify any stock in your portfolio with a dividend yield above 5% and ask yourself, why is this yield so high? Is the company growing or is the stock price falling? High yields often signal trouble. Step 3, create a retirement income plan based upon systematic withdrawals, not dividends. Use the 4% rule as a starting point. If you have 1 million, plan to withdraw 40,000 annually by selling shares once a year or on a monthly basis. Adjust for your risk tolerance and time horizon. Step 4, rebalance towards total return. That means diversified index funds in all the different categories, U.S. and international, stocks with moderate dividends, and a mix that prioritizes long-term appreciation. So here's your 5-minute challenge. Spend 5 minutes this week calculating what your portfolio would look like if you focused on total return instead of high dividends. I have an online calculator you can go to, and I'll have that in the description of this podcast. So listen, dividends aren't evil. They're an important part of a portfolio, but they're not magic either. They're just one piece of total return. And if you're chasing high dividend yields while ignoring price appreciation, you're leaving massive wealth building on the table. The wealthy don't retire on dividends. Maybe some have enough wealth where a 2% or 3% dividend can provide the income they need, but they retire on total portfolio value. They build big and then they withdraw smart. And you can do the same. If this shifted your perspective a little bit, do 3 things right now for me. Number 1, hit the subscribe button. I do an episode every single week. Number 2, share this episode with someone still trapped in dividend-only thinking. And number 3, reply to my pinned comment and tell me, are you team dividend or team total return? And once again, this is Brian, the Wealth Decisions Guy. Thanks for listening, and I hope to see you next week.